Mr. Elerian, thank you so much for taking your time. It's a pleasure to have you with us here in INFOMONEY today.
It's a great pleasure and it's a huge honor for me. Thank you.
Great. So, in 3 weeks, we will have a very important monetary policy meeting in the United States. Markets bet that the Fed will finally start cutting interest rates. How far do you think the Fed will go in this meeting?
So in this meeting, I think the Fed will cut interest rates by 25 basis points, a quarter of a percentage points. I don't think they will cut by half a percentage point unless the employment report, which is due in a week's time, is really bad. No central bank likes to start a cutting cycle with 50 basis points. I think what happens afterwards is much more uncertain. So the market is confident right now that they will cut a total of 1 percentage points this year and another percentage points in the first half of next year. So total 200 basis points. I think that is excessive. I think we will probably get 75 basis points this year and another 75 in the beginning. And then the Fed will wait and see. But the marketplace is looking for very aggressive cuts.
But this is what you think the Fed will do, or this is what you think the Fed should do?
That's a really important distinction. This is both. And it's not often that I have both. The reason why it's both because this Fed is slowly changing. It's changing in 2 ways. One, it has realized that the balance of risk is now just not about high inflation, but also about high unemployment. But also, it has realized that the environment in which it's operating is changing. And therefore, if you read carefully what Chair Powell said at Jackson Hole, he did say we are data dependent, but he added 2 other elements to how they're going to consider. And those 2 other elements are forward-looking. So we have a Fed that was excessively data dependent that is starting now to be more strategic.
Well, in the surge of inflation during the pandemic, the market said, and the Fed eventually admitted, that it took too long to start raising interest rates. Now there is a perception that the Fed could have started lowering the rates before, which I think is also your view. Do you think the Fed is behind the curve once more, and why?
So I was among those who encouraged the Fed to cut interest rates at the end of July. I thought they should have started because of risk mitigation. But whenever you are implementing policy in an uncertain world, you have to ask which mistake is recoverable. If I make a mistake, which one can I recover from more quickly? Now, the difference between July and September is not huge. And the Fed is lucky that the economy remains robust. The mistake it made in 2021 will go down in history as one of the biggest Fed policy mistakes. When you think about it, starting in April, May, people were saying, be careful of inflation. The Fed took the view that inflation was transitory. Transitory is a very dangerous word. When you tell someone something is transitory, you're telling them it is temporary and it is reversible, which you're basically telling them don't worry about it, forget about it. It took till November, the end of November, for Chair Powell to retire the word. But in March, the following March, the Fed was still injecting liquidity into the economy. It hadn't finished its QE yet. So when you look back, there were mistakes of not just policy implementation, of forecasting, of communication, of accountability. So that mistake, the Fed does not want to repeat a mistake like that. It has been working very hard to restore its credibility, and it's doing a good job of restoring its credibility. So I think they're going to be much more careful this time.
Right. Yes, but a week ago, Jerome Powell was clear in his Jackson Hole speech that it's time to adjust the U.S. monetary policy and so on. But you said you expected him to go further in seeking to regain the policy and economic narratives. Why do you think he didn't go far enough? And how could he do that?
So he said three important things. One, as you said, he said the time has come to adjust policy. Two, he said the direction of travel is clear. But it is the third thing that he said that very few people have picked on, which is very unusual for the Fed to say, which was that the Fed is not looking and is not hoping for higher unemployment. That was a very strong statement. Now, if I had been the Fed, I would have gone further. Because all that he said was, this is the highway we're going down. He didn't say how fast, and he didn't say what the destination is. And the reason why markets have been very volatile is because they're lacking three distinct anchors. First, policy guidance. The Fed has been so data dependent that they haven't given clear indication of where they think the neutral interest rate is, the equilibrium interest rate is. So the marketplace has run away with that idea. Secondly, while growth is still good, it's not as robust as it was last year. And then the third thing is there's still a lot of over leverage in the market. So you don't have a policy anchor, you don't have a growth anchor, and you don't have a technical anchor. And that's why we have this ping pong of narrative. That's why we have so much market volatility. I mean, I'll take you back. The day of the last Fed policy meeting, the consensus was everything is fine. 2 days later, we have a weak unemployment report. The consensus is that the economy is going into recession. There are people coming out and calling for an emergency, immediate interest rate cut. 10 days later, we get a weekly jobless claims, which is very noisy. Everything is fine again. This should not happen. This is the biggest economy in the world with the most mature institutions. We should not have the economists playing ping-pong narrative, changing their minds every few days.
And do you think there is still room to be more clear about that in the communication and so on?
Not just there's more room, there's a necessity to do so. There's a responsibility to do so. The Fed is not just the US central bank. It plays a very important role in the global economy. So if you have volatility of narrative and volatility of markets at the center of the system, it makes other countries have to navigate a much more difficult environment.
Right. You mentioned the work market, and the Fed has a dual mandate in its conduction of monetary policy, which is control inflation and maximize jobs. Is any of those two roles more important in this moment when we look at Fed's authorities' speeches?
So this is really interesting because it depends who you ask. If you ask most Fed officials, then they'll tell you we have a dual mandate, and we've always had a dual mandate, but the inflation side of the mandate was more important, and now it's balanced. If you look at what Chair Powell said, he said, inflation, I'm not worried about so much anymore. I am worried about the employment part. So he suggested more emphasis on the employment part than on the inflation part. If you look at the market believe and are pricing a single mandate Fed. The market now are pricing that the Fed has gone from being single mandate on reducing inflation to being single mandate on making sure that we don't get another increase in the unemployment rate. So depending on where you look, you go from balanced dual mandate, which is where most Fed officials are. And if you look at what they said after the Jackson Hole, they tried to bring back from where Chair Powell had gone to the marketplace, which is things that the Fed now is operating with a single mandate, and that is the unemployment mandate.
And from what place do you look at?
So I think this is still a dual mandate Fed because the Fed has a 2% inflation target. My view is 2% inflation target is too low for this global and domestic environment. But if you're going to stick to 2%, then the battle over inflation is not won as yet. If you had a target between 2.5% and 3%, which is where I think it should be, then the battle would have been won. But Chair Powell has been very clear that 2% is their target and will remain that target.
Are there any chances that this target changes in the near future?
No chances that it will change formally, but there is a chance that it will be pushed back. So the way you do this is you say 2% remains our target, but we're not going to rush to it. We're okay with 2+, and then we will get to 2% in a sustainable manner. So what you do is you don't change the target, you just change the way you get the journey to that target.
Great. Currently here in Brazil, the market is pricing that we will see an increase in interest rates on the same day, that the Fed is expected to make its first cut. Do you think it is already time to raise interest rates here in Brazil again?
I think it's difficult. I think the central bankers in Brazil have been very clear in saying all options are on the table, and they have taken the data dependency. And I understand why, with inflation above the 3% target and with core inflation going up slightly, the marketplace has fallen in love with this. I think the marketplace is more hawkish than where I would be. But then the central bank has been incredibly responsible. We looked at what the Central Bank of Brazil did. It moved way before anybody else to battle inflation. It did not wait. It did not make the mistake that the ECB made, that the Federal Reserve made. It understood early on the need to move. So it has developed this reputation of being very hawkish, and I think that's what you're seeing happen in markets.
You mentioned that our central bank is also data dependent in this moment. Is there a risk of this data dependency, as you see, for example, in data dependency there with the Fed?
I think you have to be concerned not to be too data dependent. I think the reason why Brazil has an opportunity to manage this situation is because growth has surprised on the upside. If growth hadn't surprised on the upside, then excessive data dependency would be a real risk. But growth, thankfully, has surprised on the upside.
Great. You recently said that for the first time in 2 decades, you are optimistic that advanced economies could break out of a low growth route. I would like you to explain why, and also to share your thoughts about the emerging economies like Brazil.
So the West has been in this low-level equilibrium where it was not investing in its engines of growth. And it got there in about 2004 and 2005 when it believed that finance was the way to productivity increases. And if you look back at what was being said then, what was being said is finance has become very sophisticated. It said that finance is now the next level of capitalism. So you get agricultural, industry, manufacturing, services, and if you're really good, you get to finance. Countries started all competing to be the world financial center. And if you were Switzerland, if you were Iceland, if you were Dubai, if you weren't big enough, it didn't matter. And suddenly, we lost sight that finance services the economy, and finance cannot get bigger than the economy. Then we had the crisis. At that point, we should have invested in productivity enhancing. Instead, we substituted the public balance sheet for the private balance sheet. So you got central banks expanding enormously their balance sheets. You got fiscal deficits are very high. This whole period, there was very little investment in drivers of growth and productivity. People now understand that was a mistake. So if you look at the new UK government, it came in and put growth as a mission, a growth mission. And they've understood that there are 2 parts to this mission. The first one, and they're using the analogy of a car, is you release the brakes on your productivity enhancing engine. And the second one is you create new engines. I'm saying all this because my optimism about the future, and I view that we are on a bumpy journey to a better destination. The world is being shaken from above and from below. Above, we have three sectors that promise significant productivity gains: technology, life sciences, and sustainable energy. From below, you have certain segments that are being forced to adjust: healthcare, food security, and defense. And those tend to have positive externalities in terms of productivity. So I see that within 2 to 3 years, we will have a significant potential for higher productivity and higher growth. Now, this is really good for the emerging world, because the emerging world depends on the global economy to a large extent. And you cannot be a good house in a bad neighborhood. If the global economy is a bad neighborhood, it's very hard to be a good house. So I think this is really important, but it's very critical for these countries to also understand that they need to get on the bus when it comes to these future drivers of growth.
Yes, productivity, for example, is a traditional problem here in Brazil.
It is, and there's a window now because of these innovations, and these windows don't happen very often. There's a window now to turbocharge your productivity, but it has to be managed well.
Great. How could Brazilian investors translate, let's say, this outlook you have for developed and emerging countries into their portfolios in the domestic and the global markets?
So this is a world in which theme investing becomes very important. It's a very different world from before, where it's how much in bonds, how much in stocks. This is a world in which you have to ask yourself, am I investing in the themes that are transformational or not? And that should be a good part of your portfolio. You also need an important risk mitigation to be able to manage the journey. So I always ask people, forget about what percentage in stock, forget what percentage in bond, answer 3 questions. Does your portfolio has resilience? If, for example, we have a shock of some sort, like we did at the beginning of August, will you be able to sleep at night? Or will you be asking, what do I need to sell to raise liquidity? So the first thing is, do you have enough resilience? Because in a world that this is uncertain, you are likely to make a mistake. You don't want to make a mistake, but it's like falling down and getting back up. You have to make sure you get back up. So that's the first question. Do you have enough resilience? And if the answer is no, then you should look at your asset allocation and build resilience. The second thing is, are you open-minded? Do you realize that correlations are changing? Do you realize that volatility is changing? Are you open-minded enough to be able to look at the whole range of things, or are you stuck in an old-fashioned way of thinking about this? And then the third thing is, how agile are you? Do you have 10% of your portfolio that is opportunistic, that can take advantage of opportunities opening up? And if you have to be able to answer these questions in order to have the sorts of portfolio. Now, it matters a great deal what your portfolio is for. And that's why I like putting it in terms of, can you manage these 3 things or not?
And in your opinion, what are the themes that reserve good opportunities from now on?
So there's positive and negative. Let's start with the negative. The negative is the world is fragmenting. And increasingly, other countries, not Brazil. Brazil is one of the very few countries that is a middle power that will continue to be able to interact with both the US and China. But other countries are going to have to choose. Mexico is going to have to choose. Brazil is not going to have to choose. So the first thing is, do you understand that the world is fragmenting and that this is going to have a very different impact on different countries? Second thing, so that's on the negative side. On the positive side, do you have a claim on these innovations coming from technology, life sciences, and sustainable energy? Because they are transformational. And you have to, so if you think of it, you have to play both offense and defense, but you have to have a different mind. on that.
Great, Mr. Alerian. Thank you so much for your time and for this interview.
My great pleasure. Thank you.